Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about Bank of America, and that is because they are going to be announcing earnings later this week. That's going to be 9:30 a.m. is the earnings call, so expect those numbers to be out a little bit before then. Normally it's around 8 a.m., and that is going to be on January 13th. So it is currently January 8th when we're making this video. So the reason that I want to talk about Bank of America, we haven't come back to the big banks, which is something that I track pretty closely because that is the industry that I am involved in. So overall, the banks have continued to perform very, very well this year. When you're looking at bank income statements, I'd call out that one of the big movers on the income statement that is built out by bank management as well as economic models is the loan loss provision. So this is how much a bank is holding back in reserve in expectation of future losses. Now, if we look at this on an annual basis, you can see that over the past 5 years, when we look at loan loss provision, we saw some pretty hefty increases, in particular as in 2020 when we saw COVID begin to impact. And then we saw a large decline over the course of 2021, and that was able to positively benefit the company, or really the entire banking industry, but in particular Bank of America, to the tune of $4.6 billion when we're talking about the overall benefits associated with the loan loss provision. So going forward, what are we expecting? Well, when we're looking at the quarterly numbers, what I'm expecting to increase in association with higher interest rates is interest and fees on loans. So when you book a loan that is going to be primarily interest heavy, so if you book at a mortgage and you look at an amortization schedule, any 30-year mortgage, about 80% of those payments when you first start out is going to be primarily interest, not the principal on the loan. And this is how banks make their money when they are lending that out. So as you can see right here, even just over the past 4 quarters, when we started seeing interest rates materially rise in Q2 and Q3 of this year, and even more so in Q4, you can see that corresponding increase in the overall interest income. So what'll be interesting going forward is this interest income going to continue to rise? Do we expect loan volume to continue to grow at the rate that it's been? And what are we going to be expecting going forward? So already when we're looking at the annual numbers, you can see that 2018, 2019 had higher interest income than 2020 and 2021. 2021 in particular was quite low. Now I expect this trend to reverse, and we expect to see interest income continue upwards. The question is going to be, do we expect to see things such as non-interest expense, which is down here below, so you can see the different non-interest income and expense. Do we expect to see other expense and labor and related expenses to go up in an environment where we may see more loan workouts, where we may see additional losses? At this point in time, banks are not seeing increases in loss activity, and overall non-accrual and probability of default models don't have many institutions back at levels that they were at in 2019. I'd call out that many institutions or many individuals are saying that we're seeing large increases in credit card debt, mortgage debt, student loan debt. Debt is going up. However, we're not saying debt default go up at this point in time. However, that is something that if it were to break, if we were to see that industry move towards heavy default activity, I would expect that to be a rapid move. So, therefore, what? All in all, Bank of America, as well as a number of the other large banks, continue to trade in a similar range to where they've been at for the past 5 years. So why would we want to be trading, or why would we want to be paying for an investment that may or may not be increasing? So you can see that in COVID, they did drop down to about $20 a share. But the reason why we want to make a consideration like this is over time, banks have historically done very, very well as capital conservation. Again, they do pay a dividend. Right now, that dividend is right at 2.5%, 88 cents a year. So if you have 100 shares, you would be getting $88 per year. And this is something that you would be able to benefit from on a go-forward basis, is that you are getting that quarterly dividend and continuing to grow that investment. You can use it to buy additional shares. And again, it's something that overall could be very beneficial. That being said, I think that if you look on a year-to-date basis, or probably the one-year chart since we are now in 2023, is that while the trend down has continued from that 40 $45 to $50 a share. We're now in the $30 to $35 range, and it's continued to bounce off that $30 support. And again, I'm by no means a technical chartist. It just looks that way. But despite the fact that we have started to see or stay in this range, I do think that banks, compared to historical metrics, continue to stay a little bit higher. And we have seen a number of dividend-related funds or investments continue to stay elevated when the overall tech sector has been dropping hard. So, as someone who's an overall bear on the market outlook at this point in time, I would expect to see banking stocks follow the broader market down over the next 6 to 12 months as we continue to go towards what is broadly perceived to be by other large research-based firms to be a recessionary environment. So with higher charge-off activity and lower loan growth, I would expect that to negatively reflect on Bank of America and other large financial institutions. That being said, if you're playing the long game, I do think that the major banks will continue to be here 10 years from now and continue to be profitable, which is not something that they struggle with at this point in time, as you can see from a net income perspective being north in 2021 of 31 or right at $32 billion of net profit. So they are going to be announcing earnings, and what I'm going to be looking for is their expectations looking forward. Do they expect there to be higher levels of charge-off in the future, and are they reserving in accordance with that? Do they expect loan growth to continue at 2021 levels? What are they looking at from a consumer side? What are they looking at from a commercial side, in particular commercial real estate? And it'll be interesting to see their commentary and how that could affect the broader market. So when we see them announce earnings, this is also going to be directly after we see the CPI, the inflation data, on Thursday of this week. So between the bank commentary on Thursday and Friday and the CPI numbers on Thursday, I do think that we could see some big moves in the market this week. So stay tuned by watching the channel, hitting that subscribe button, and if you find this content helpful, please hit like and let me know in the comment section down below what you think is going to happen in the market this week and your thoughts on Bank of America, other stocks, or even big banks in general. So if you made it this far, thanks for watching and talk to you soon.